Hello, everyone. Nice to meet you all. I'm Serena, RWA tokenization lead from Polygon Labs. Really excited to be moderating this very timely chat. So we are seeing a very big stablecoin battle playing out over trust, adoption, and also regulatory staying power. So the big question is who will be winning the long game? So joining us in the panels today are three leaders shaping the space. Nick from Agora, CEO and co-founder, Jane from Ethena Labs, institutional growth lead, and another Nick from Paxos, our head of crypto business. So start with the fundamentals. So perhaps start with Nick from Agora. What is the core idea behind your stablecoin, and how does it answer the question of tackling stability and also scalability?
One of the things that we were seeing in the market prior to starting the business is, the thesis is that stablecoins really eat the entire euro-dollar market. So we were at about 150 billion in stables 3 years ago. That's a pretty big room for growth. And you had two issuers, one that really didn't talk to anyone, and then another that had a single partner in Coinbase. And so it was a very simple idea, right? Is that you had all these businesses that were contributing utility and liquidity to this broader ecosystem and using these assets, but had no relationship with an issuer. And so the very simple premise was building an institutional grade enterprise first stablecoin, and one that really partnered deeply with a variety of businesses, whether that's DeFi protocols, payment companies, traditional asset managers, to build a network. And so that was the original idea. Something that was really important to us from the beginning was being institutional grade. And so State Street is our cash custodian and fund admin. They're one of the largest GSIBs in the world. They custody tens of trillions of dollars, so you really can't get safer than them. And it's important for scalability. If we really believe that stablecoins are going to be a multi-trillion-dollar asset class, you needed to have a custodian bank that oversees trillions of dollars in collateral. So they're the cash custodian fund admin of the Agora Reserve Fund. VanEck, which is my family's business, perhaps unsurprisingly, is a 70-year-old, 100 billion plus asset manager. They manage the reserves, and so you have two very blue chip traditional financial services institutions that are in charge of the management of the underlying collateral. And so what we do is go to businesses and say, hey, we'll share in revenue or reduce our fees to be a better partner to you and help grow your business.
Thank you, Nick. Jane?
So Ethena's USDE, I think the backing is a little bit more different than other stablecoin. We use like delta neutral strategies, which means like you buy spot ETH or BTC and short perp BTC or ETH to create this US dollar backing. So I think how we deal with the scalability is really the deep liquidity that across the different CeFi markets, and we also use institutional custodians to help our collateral to have this, like more avoid this like counterparty risk from custodian central exchange. So that's how we design our mechanism. Yeah.
Nick?
Great. So for USDG, I think there's really two key components. There's one as the issuer, and really I think our role here for scalability, safety, trust is to be open, transparent, have regulatory clarity. We're prudentially regulated by the MAS. As of this morning, we just also announced we're regulated under MiCA, and think that that's really critical for bringing on adoption. The second area is distribution. We give a lion's share of the stablecoin economics over to distributors. We think that that's where the stablecoin market is definitely going to end up. And partners like Robinhood, MasterCard, Fiserv, they are already operating with the highest degree of scale, trust, and transparency in the market. And I think having firms like that come on board to build on top of USDG is really what's going to get us there.
And we are also seeing a lot of banks like JP Morgan and also central banks entering the space. So what's your stablecoin's edge over the CBDCs and also tokenized bank money? So perhaps start from Nick.
Yeah, well, I mean, I think the first big one is probably that it exists. And I think just like having it out in market, like getting the distribution, getting the adoption, and serving those use cases now doesn't really matter. I think that, we're probably not going to see a CBDC in the US for at least a few years. We'll probably see them in local markets and local currencies, and they're going to interoperate with the major stablecoins that are the winners in the space. And then I think we probably will see tokenized bank deposits in the US, and then they're going to have to figure out how to interoperate as well. It'll be interesting to see how much adoption they can drive outside of their bank, and I think that's really going to be the question of where they land.
I also think they're solving a different problem, right? If you're trying to build like a global liquidity and utility layer, that's like a fundamentally different problem than what JPM is solving with their token, which is just within their own bank settlement, right? You're not going to have B of A or Wells Fargo that is accepting JPM coin for settlements, so it will only be accretive to JP Morgan if they're able to bring in net new capital specific for that reason, but I don't think that's their intention. It's really to improve settlement times within their bank and with their own customers. So I think it's really like a totally different USP than something that a USDG or AUSD or USDE is going after.
Yeah, I do think like the liquidity is gonna be a problem. That, as Nick said, that like Wells Fargo, Citibank is not gonna use like JP Morgan's stablecoin. It's gonna be like super fragmented. The adoption will be very difficult. Also, I think the composability of DeFi will be something that they're not gonna be able to navigate across this like ecosystem. So USD will be like pretty much like the DeFi base EO layer for a lot of strategies, traders. So that's something that I don't see this like CBDC can achieve. Yeah.
Thank you, Jane. And Nick, I would like to ask on your views on recently AUSD has been released a rating on the Anchorage stablecoin safety matrix. Could you share your views on that assessment and to share more about
Oh yeah, so I guess for people that don't know, Anchorage delisted USDC and AUSD last week for safety concerns. So frankly, like we find it pretty unserious and bizarre. They knowingly publish false information, so they know that State Street's the cash custodian and the fund admin. And that would have attained a 4 out of the 5 on one of the 2 axes, right? And so to us, it's just unserious and bizarre. It is what it is. I don't think Paxos was involved at all. Great business, great company. But from Anchorage, it's just kind of weird, right? If you can delist assets for obviously economic reasons, but to do it in this weird, USDC is unsafe, the second largest stablecoin in the world, is just kind of, as Victor Bunin put it, it's one of the worst architected hit pieces that he's ever seen, right? So I think a bit embarrassing for them and probably makes their brand look quite poor.
Thank you, Nick. And I think, Jane, so USD has become one of the fastest growing stablecoins in the space, especially for you as the institutional growth lead. What are you seeing for like institutional players, they most curious or cautious about synthetic stablecoins?
I think the first thing is like really the transparency, how we handle the risk, how we design the whole trading strategies, where we held our collateral, how they can verify that it's sitting there. So how we do it is really like try to improve the transparency. We build this transparency dashboard. We also increase this like weekly proof of reserve report from different verifiers that you can see on our website. So that's something that I would say like most of the institutional players or traders, they are most concerned. And I think that's also most of our users at the point. Yeah.
Thanks, Jane. And Nick, back to you. For like Paxos operate under several countries' oversight. So I would like to understand from a perspective, how do you balance between growth and also complying with regulations?
Yeah, I mean, I think that we're here because we all think that trillions of dollars is going to move on to the blockchain. It's going to move on to stablecoin over the next 5, 6, 7 years. And we're really confident that that is only going to happen in a place where there's like lots of regulatory clarity about how stablecoins are operated, about how they're kept safe, about how the reserves are managed. And so it isn't so much a balance necessarily as the regulation we think is core to the growth that's going to happen. And we think that by seeking out the regulation and operating at the highest standards, there are partners and opportunities that we're going to be able to support that just would not be able to use a stablecoin that didn't meet those standards.
Got it. And do you guys think like USD-backed stablecoins are still the end game, or do you see any credible demand from like emerging markets?
There's definitely demand from emerging markets, but it's often for US dollar stablecoins, right? So, our view, and USD-based stablecoins are about 98% of the market, give or take, is that it'll probably go down closer towards 90%, but still be the most in-demand stablecoin because you have a bunch of sources like EM dollar demand, right? You have hundreds of millions of people that are living in countries where there's high inflation or reduced access to capital markets, and this is just a store of wealth for them outside of their local currency. And crypto is frankly a venue for financial opportunity for them. You see places in Turkey, right? So we have someone that's based in Turkey. Tether trades above $1 in Turkey. And in many of these emerging market economies, and why would something that's only worth $1 trade higher than that? It's because people are so eager to get out of their local currency that they're willing to sort of pay more for what it's worth, so to speak.
Yeah, I do agree. Like US dollar, like denominated stablecoin is gonna be the dominant force of stablecoin. I used to live in China, and then the forex control, lack of financial opportunities for local people. So every capital flow into the property market, and it became a huge bubble. I think if they have access to US dollar denominated stablecoin or different kind of investment opportunities, they will for sure seek this kind of opportunity instead of property market. Yeah.
I agree with all of that. I think the only thing that I would add is that I do expect we will see local currency denominated stablecoins. Like countries are still going to have monetary policy. They're still going to have protections that they need to have in place. I think that for all of those reasons, they're just going to have to interoperate with US dollar stablecoins to probably a much greater degree than their economies currently interoperate with US dollars. And hopefully that'll be a good thing for everyone.
Yeah, I think whatever the balance of non-USD stablecoins will be on chain is really related to flow, right? So there's sort of the stock component of money where people are just holding it, and then the flow. I think a lot of non-US dollar stablecoin adoption will be driven just by flow, right? So spot trading to move from one currency to another between different markets. And so whatever is the minimum value and liquidity threshold needed to support those FX markets on chain is probably what you're going to get from a non-USD stables.
Understood. And then final question for the panel. So if we reconvene 5 years from now, what do you think would surprise us the most about stablecoin development? And back to our title, what will be the determining factor of a stablecoin winning the Lindy race? So perhaps ladies first. So Jane. Me? Yeah.
Okay, so I think my personal view would be I think a lot of emerging markets, local currency like African countries is going to be replaced by US dollar stablecoin that we see in Africa or some part in South America. That's cross country settlement is already done in US dollar, and they don't really have a banking account, so it's very easy that they store the money on the mobile phone and then they just pay each other on the phone. So that's something that I really think that stablecoin is going to replace the local currency. And for the Lindy game, I think liquidity and also distribution will be really the key for the stablecoin to survive and to be sustainable for long term. That's something that Tether is really dominating this space, and it's really difficult to compete with them with their local presence, trust of these emerging markets, also offline presence. That's something that I would say most of the stablecoins takes years to build that.
Right, Nick?
Yeah, the Tether team is great. I think there's a number of different avenues for growth. To Nick's point earlier, I think a lot of the adoption that we see will come from regulated or traditional businesses that are bringing non-speculative flow to markets, right? A lot of what has happened to date is Tether really grew up in this sort of era of crypto trading. A lot of USDC's success initially came from both the Coinbase partnership, but then also their early entrance into DeFi. And so you really have to think about okay, what's next? Something that we think a lot about is payments, so cross-border. And then merchant payments as well, and you'll have maybe different winners in those categories. We already talked about this a little bit, but EM dollar demand, right? People in Argentina and Turkey and other high inflation economies want to just hold dollars because it's a better store of wealth for them and can provide an access to a lot of financial opportunities. FX, on-chain, spot, that'll continue to grow. We're really in the infancy of that. It'd be failed to mention RWAs and sort of institutional adoption, right? We think stablecoins will be the cash settlement mechanism for a lot of these fund products, but also just the trading mechanism against many of those. So we're spending quite a bit of time there. And then there's a few others that we're spending time, but I'm not going to get into it quite yet, as we have some product announcements that we'll make. But
yeah, I think my answer might be actually pretty similar to Nick, but like if you look back 5 years at sort of the least compliant, least regulated stablecoins that won. Like Tether obviously took the largest market share, USDC took a middle ground, and they're kind of a solid second place. I think if you look forward 5 years, I really do believe that it's going to be the stablecoins that are like regulated and compliant in those frameworks that are going to see the money that really moves on chain. And that's just going to be a big shift that's happening right now with things like MiCA and the Genius Act and all of the stablecoin regulatory frameworks that are coming out. And then the other thing that I would just add to that is that, and I don't know exactly which companies are going to get this right. I think we see some early signs. There's a sort of like temptation, or it's very easy to just think of a stablecoin as an asset. I think the firms that really figure out how to think about stablecoins as infrastructure and really build on them as like a rail, they're going to be the ones that actually ultimately win in the space. And the solutions that they have, the products they bring to market will just be better. And the ones that just kind of like want to take a half step in and like list a bunch of stablecoins, it's going to be the most commoditized part of the space, and it just won't matter in 5 years.
Thank you, panelists. And let's mark our calendar to reconnect in 2030, see how predictions are played out. Maybe we'll put it on a poly market as well. But let's see. So thank you, everyone. Have a great day.
thank you.
Thank you.